All right, welcome everybody to the stream. My name is Kyle. Here with me is Dan. I even added in, look, we got little Dan's channel. We have my channel here because I
Woo-hoo!
realized we don't talk about that a lot. So if this is your first time on the stream, let us know in the chat. We'd love to welcome you here. We already have a few people in here. We have Honey Buns as always. Thank you for being here. Stan, Cal, Eric T. I don't know how to say this name. Arlie
Chicago.
C. Swayze. Let's see. We have Gamby in here as well. Leave your comments here in the chat and we'll go ahead and answer them. So we're going to talk about what's going on with the market, expectations with Fed, with mortgage interest rates. Also, it seems like a lot of people right now, we were just talking before we jumped on that people are probably waiting to see what's going to happen with the election. To wait to buy. A lot of people, I think, are kind of on the sidelines right now. Amanda's here, said my favorite Wednesday show.
Again.
Thanks, Amanda.
Thanks, Amanda.
Appreciate it. Cool. So Dan and I are both federally licensed loan officers. Our team works in all 50 states. So here are emails if you want to contact us or reach out to us. You can also go to our website, winthehouseyoulove.com, to schedule a call as well if you have any questions or you want to get pre-qualified. Let's see. Michelle said closing next week. Congratulations. You know what I need to make? I need to make a little like firework thing or something.
Woo, woo. Like,
point.
hey, does this still work?
No.
Remember if you guys think I'm crazy right now, there was times where I'd go like this and you'd have fireworks and stuff. We couldn't figure out what in the world was happening.
Yeah, you used to be able to do that, or you could do the I think it was like a rain if you did that, and I can't figure out where it went. So
remember the first time it happened, you're like, dude, what'd you do? And I'm like, nothing. You're in control of everything.
Yeah, I have no clue. Lamont said, missed out on a house that I loved because I was not ready, but I'm ready now and waiting for my next opportunity. I like it. And I think you point out a really good mindset that Dan and I both talk about a lot. Also, look at that fade. That's a great haircut. So
you need to get that. So I went, Lamont, I don't know if I should ask this. Are we helping you? Or is somebody else helping you? Thumbs up or thumbs down.
Well, this is a good mindset here that we talk about a lot, which is getting ready, even if maybe you're not exactly thinking you're ready to buy now, because Lamont said yes. Yeah, I think I remember he said he was working with Alan, if I remember correctly, and I can't remember. Oh yes, getting pre-qualified and getting ready, because it happens a lot sooner than you think. I think a lot of people think that like, okay, I'm going to wait in the future and then I'm going to buy. But what ends up happening is people who are in that mindset, they're already starting to look for homes. They're already they're already looking on, through Zillow or Realtor or whatever, some home buying app, and they find a house. And then all of a sudden it's like, oh, it's crunch time. Now I have to get pre-qualified now. And I'm trying to get things down to the deadline. And it makes it so stressful versus getting pre-qualified costs no money. There's no obligation to it. And a pre-qualification is going to be good for 4 months, 3 months of which you can shop for homes. 1 month is reserved for closing. So you have quite a while for that to be effective. And if your pre-qualification expires, you can always just renew it. And it's, again, doesn't cost money. There's no big obligation. There's no huge deal to it. And so we're more of a fan of people being ready to buy. That way, when they find something, they can actually pull the trigger on it rather than, everything getting down to the wire. So, okay. Dan, what's going on with markets, interest rates?
Don't ask. So if you guys have been watching my channels, if you watch my channel, you're probably up to speed on what's going on, but it is a bloodbath out there. And we can't, the first thing when Kyle come on this morning, just a little bit ago, he's like, what in the world's going on? And I'm like, that's the question that everybody's asking. If you watch analysts on Wall Street and everything else, they're like, what is it? So, compiling everything I can possibly get, here's the backdrop of what's happening in the background. Okay, so the federal government, you guys know how I am about the deficit. Well, I'm not the only one anymore. The deficit's starting to get even worse and worse and worse. So there's a lot of numbers that just came out recently that said about a third of our revenue that the government or the government brings in from us is used just to pay the interest. Here's an interesting thing that I found this morning. Look down right at the bottom of this chart. That's where rates were coming down. Remember, they were coming down and down. Everybody's like, whoa! It went from 7.5% in May down to almost 6%. 5.99%. Then all of a sudden it just turned and it just hit bottom. Everything hit bottom and then spiked up. Kyle, can you just cover over that and see the day that it changed?
Looks like that big spike was around October 3rd.
Scroll down. Oh, keep going left a little bit to the bottom of that blue. Keep going, right around in there. That's when the bottom. Just go over. Look at the date.
September 16th.
Okay, the Fed came out on the 18th and cut rates by 0.5%. This is exactly what we were explaining. And I was explaining to everybody daily. I'm like, the Federal Reserve controls short-term rates, not long-term rates and not mortgages. Okay, mortgages are a bond that trade on Wall Street. Okay, so the problem we have right now, there's too much. Okay, the federal government right now is like 35 trillion in debt. Okay, but you also see, if you're starting to hear some rumblings about China. China's stimulating the economy because it's bad. So they're stimulating the economy. What are they doing? Well, they're pumping out money as well. And then you have a lot of countries right now needing to get out of a fiscal jam. So they're actually printing money as well. So there is tons and billions and billions of dollars of bonds hitting the markets. And this is what I've been exactly saying to everybody. There's too much at some point. So what investors are doing, they're just going out and saying, okay, I can buy a US government bond that has zero chance of default, and I can get almost the same yield as I can get on a mortgage bond. So why would I even take the risk of buying a mortgage bond? So what you're seeing is rates going up to the point where investors will say, okay, I'll buy that debt. Well, the problem is we have right now is it keeps going up and up and up. Okay, so the backdrop of this is what I'm trying to figure out. Usually when there's a huge amount of uncertainty in the country, in the world, people sell stocks and move into bonds. Well, our bond market isn't capturing that money right now, and I'm not sure what country is, because a lot of countries don't have the debt grades that we have in stamping them. Like the grades of the U.S. debt, I think it's still AAA. It might be AA now or whatever it is, but it's still there's basically no chance of default, and that's what's happening in the background. So tomorrow is Thursday. We have the unemployment numbers coming out. I don't know what they're going to come in as. And I hate to say it that way, but the problem behind it is you had multiple strikes going on. You had the hurricane that just happened. So the numbers are going to be, I'm saying, how do you get an accurate number when you have probably an eighth of the country underwater at some point? So it's going to be hard readings. And then in 2 weeks, you have the election. And that's everybody's, I think, just on pins and needles right now. So I think you're seeing a lot of people just profit taking, pulling their monies aside until the election goes through. You will be seeing money rolling back into the market, the equity markets, and probably treasuries as well, because investors, a lot of hedge funds and other investors, they're looking to put their money to work for them by the end of the year to try to capture some gains. So you'll see the stock market at the end of the year, though they call it a Santa Claus rally. It normally rallies, but the interesting part of all this is we're going to kind of pay attention with what the bond market is doing. So if you want to learn, if you really want to take a deep dive into the economics behind things, and on my channel, I also talk, like yesterday, we had a stock talk with Dan Frio, because a lot of people in my description down below, they're like, I'm broke. I don't know what to do. And if you ever talk to Kyle, he's an awesome young man. The reason why he has his finances in place, you should talk to the kid about his budget. And that's where so many people fail. So when you talk to Kyle about, how did you position yourself for your first home? It's amazing how he goes through all the numbers and the analytics behind it, and he has a plan. So a lot of people just don't have a plan. You probably got out of college, high school, college, whatever you went to. you probably still don't have a budget. And I think that's one of the big point that's the big areas we have to really, on you and my end, we have to help people on that part of the equation. And that's why I started doing Stock Talk, just to teach people just the fundamentals about the market. Okay, so that's
Yeah.
basically what's going on right now. So a lot of analysts just we don't know what's going to, people don't know what's going to go on, and the uncertainties are the ones that's creating all this havoc right now. And if you,
Yeah.
even if, Kyle, I don't know if you have it tagged up, but if you can pull up CNBC, just their homepage, I mean, it's red everywhere. And and CNBC, the cool thing about CNBC, when you pull it up, you can see what's going on in the stock market in the US. Look at it. The Dow's down 400 points. And it's all related to the treasuries, it'll say. But the funny thing is here, not funny, but click Europe, EUR, and right above, yeah, right there, red. Asia, red. Bonds, they're going to be green because they're going up. Oil is, let's see what oil is doing. But these are the things I follow on a daily basis, and there's reasons for it. So check out my channel if you would. There'll be a lot of economic information on there, and then Kyle's channel teaches you how to basically buy homes. Is how we kind of tag this together. So that's it right now.
Sweet. Let's jump into rate locks, and we'll go to a couple questions, and then we can jump into some of the grants as well. You want to go through rate lock suggestions here?
Yeah. So here's I guess the bad news here. I'm still saying if you're 7 to 15 days away, you got to lock. I mean, you have to lock because you need to lock to get to the closing. If you're going any further out, I'm an opponent right now. The rates ran up so fast. There's got to be a relief rally here somewhere. And Kyle just pulled up what rates did since the Federal Reserve cut rates. I mean, they're up probably at least half to 0.75%, and we're only talking like days. So it's a huge move, and it's shocking the markets right now is the best way I can put it.
Yeah. Yeah, I know. I feel like we talked about that for a while. It was like 3 weeks leading up to the Fed rate cut about like, hey, this isn't going to change rates. This isn't going to change rates.
Yeah.
We don't know what's going to happen to them. And I feel like people were still kind of pushing back on us with those. And it was like, well, that's kind of what we've been saying for a little bit.
The deficit is going to come into play. In previous elections on all that, they bring up the deficit. I mean, they've been bringing up the deficit since it was like at a trillion. It's at 35 trillion now. So a lot of all those carrots that people were dangling is affecting us. So let me put it this way. There's a lot of, I get a lot of grief saying, I'm not all for the student loan forgiveness and all this other stuff. And the reason is, it's not that I hate students. I got 3 kids of my own. All this free money is getting financed, and it's going to be financed by all of us because you're seeing it in rates right now. Okay, so what's happening behind the scenes is the government doesn't have, the colleges got their money. I'll just pick on the student loan piece right now. The colleges got their money, the students got their education, and who's paying for it? Well, if they're not going to pay for it, somebody has to. Well, the federal government's going to pay for it. Well, they don't have enough money, thus a deficit. So they're going to have to print bonds. Like that's exactly what we're talking about. And there's so many of them. That's why rates are going up. So we're all going to pay on credit cards, car loans, mortgages. Everything is going to be higher priced because of all the free giveaways that the government gives. So that's my biggest pet peeve. Now, if we had a surplus, help everybody. But we have a $35 trillion deficit. So I'll leave it at that.
Cool. Let's jump into some questions here. We have Swayze.
Good thing I'm in a good mood today.
Why is that?
I'm just saying. I probably seem like I'm yelling at everybody, but I'm passionate about it. So sorry.
Yeah. I don't think people take it that way. I work in the service industry and was wondering, once I get to a full year of employment with my current job, will the underwriters approve me for a mortgage loan? Credit score is 770 plus a 20% down payment. I think, I guess it's really going to depend how much you get paid, or not how much, how you get paid. So is it primarily tips? Do you also have a base pay? What's your base pay like? I'm imagining if you're in service industry, you probably have base pay plus tips. And you might work overtime, things like that. Really what the underwriter is going to look like after a year of employment is how much variable income is in there. A year, so they need 2 years of employment. We're also going to have to take a look at what the year before was. Was that in the service industry as well, or was it in a different type of employment? A year can work, but it can be a little bit tough when you're looking at variable pay. Underwriters tend to want to look at 2 years of variable pay to be able to average that. However, you do have a high credit score and high down payment, so that can help offset that only 1 year of variable pay income. So it's likely that that can work, but it may be a lower average that we can use for qualifying income than if we were looking at 2 years, for instance.
There is a non-Q. There might be a non-QM program for you, so I'll explain that real quick. Non-QM are the loans that I guess they used to call subprime. Subprime got a bad name at the end because it was just doing real shitty loans. But this is an example where you have fantastic scores. You have a chunk of money for a down payment. You might qualify on like a bank statement program where they'll see your cash flow and see, yeah, you're making a lot of money, and they could possibly base it off of that. And the reason being is, you look at it on the lender side, the risk on it is a lot less for you because you're putting down 20%. So you can't get that in most other products, but the other products are only requiring you maybe 3, 4, 5% down. So when you have 20% down or more, you have a lot more leverage. So this is an area where I'd reach out to us and work with. There's me, David, and Alan. Those are our whole sales staff, and we'd be more than happy to walk you through that.
Stan Cal said, do you have to specifically request home ready, home possible loan products from your lender, or do they pull them automatically as part of the initial loan process, loan request process?
When you're dealing with us, we do all that. We notify you like, hey, we're going to try to get you, because the home ready, home possible programs, those are mostly first time home buyers, where you get in a lot of cases you'll get a discounted rate, and then when we run your loan through let me back up a second. What happens on our side of the equation, I'll kind of move the curtain behind. When you apply for a loan, what happens is you put your application in the system, we pull your credit, and then we upload your loan into Fannie Mae and or Freddie Mac. Now, it doesn't matter if you know who they are, but Fannie Mae is home ready and Freddie Mac is home possible. So those are mostly for like first time home buyers. Yes, there's refinances and such with that, but what that is it's deeming you can get away with 3% of a down payment versus 5, 10, 15, 20% of a down payment. So that's that part of it. A lot of lenders, they should pay attention to it. We specifically do because it helps on your rate. So if the loan officer you're working with doesn't realize you're a home ready or home possible client, they could completely miss it. They're going to lock you in the wrong program. So we automatically, it goes through 3 levels here. So I can assure you we'll lock you in the right program.
Let's see. Joe AF said, someone is selling me an off-market house. Do I need an agent, and do mortgage lenders need to approve the house? So as far as the agent, I know there are a lot of agents who will do, especially for like for sale by owners, they'll do a flat fee commission. So that might be something you want to look into. At minimum, I think it would still be, if you're not going to use an agent, I would still talk to a real estate attorney. A real estate attorney, it's going to depend on the state and how busy they are. You're going to look at like $500 to $1,500 to just set up the documents for the transaction. I think at minimum you need to do that. Often people will do transactions that have, like, the contracts might be like 1 or 2 pages, which are not good. Keep in mind, like, a contract is like a legally binding document that protects you as a buyer. Mainly the goal of a contract is to give you exits that will be able to get you, your deposit back if things go south. Otherwise, if you just have like a 1-page contract, let's say things go south in the transaction, all of a sudden the seller is mad at you now, and they take you to small claims court, or over earnest money or something like that. That's something you don't want to have to deal with. So having a robust contract is really helpful. Navigating a really robust contract that's going to be like maybe 10 to 15 pages, like most real estate contracts, it's going to be best with a real estate agent or a real estate attorney. So if you're going on the lower end side, real estate attorney to help you navigate that contract, set up those exits. Just know that a real estate attorney isn't going to be able to help you give a lot of advice on like comparable homes and valuation of the house. As far as getting a mortgage, you only need that if you need a loan. So if you need a loan, it's going to work exactly the same as a property that's on the market. So to lenders, they don't really care if it's on market or off market. We just need to see a contract that stipulates the purchase agreement, or all the terms of the purchase. Outside of that, there's really nothing different between if it's on the market or off the market. It's the same loan, same approval requirements, and things like that. Nina said, looking in Delaware. Thanks for being here, Nina. Michael said,
Thanks, Nina.
I have a tri-merge score in the 500 range. In this current market, can I realistically qualify for a mortgage, FHA, USDA, etc., without waiting to get my credit score up to 620, 640 or higher?
I'll give you the parameters on the credit scores and kind of walk you through that piece of it when you're in the 500s. So if you have a 580 credit score or higher, you can get approved through the automated system. Now, what I was just saying before is when I said I'll give you behind the screen, we take your application, you fill it out, we run your credit, and then we push your data out to Fannie Mae and Freddie Mac. That's how loans get approved. And Fannie Mae, FHA loans do. USDA uses a different system, but we have that access to that system as well. USDA is harder than most people think. Everybody sees zero down and all this other stuff. It's really hard to get a USDA loan approved. But if your scores are 500 or 580 or higher, you can get an automated approval. And if it gets automated approval, meaning when we upload your data into Fannie Mae or Freddie Mac, if one of them approves it, you're good to go. If it doesn't, we can recommend or send it in for what's called a manual underwrite. Those are really tough, especially when you have the mid 500 credit scores, because you probably have some dings on your credit. So a manual underwrite, it reduces your loan or your debt ratio down to a 41 back end debt ratio. And I know I'm probably getting a little in depth here. I'll polish it up here in a second. Most loans on FHA, you can go to a 57 debt ratio. If you go to an FHA manual underwrite, I think it's 41, 43 is the guidelines there. So it's a lot tighter. And there's a lot of dings that you can't have. Like you can't have a major default in the last 12 months. Well, if you have a 580 credit score, and Mike, no disrespect, but you probably have some dings in the last year. You might not. So yes, it is possible. It might be really tough. We'd love to work with you. Just call in or just go right up through here. And you'll be able to schedule an appointment probably tomorrow, and it'll be with Alan, David, or myself, and just tell us what you're working with. This is why we do these consultations. We want to get the story. We don't want you to just put all your information automated and blah, 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 and do it behind the scenes. I don't know anything about you. I'd like to learn, what are you looking to do? How are you looking to do it? And help navigate and piece this puzzle together. It's like a clay blob. Give me the clay and let us help mold it into a loan for you. So, check it out. Ooh, if you don't
Master
mind
Potter over there. I will say our video thing has a credit score selector, and kind of you won't be able to schedule if you have below a 580. So just email Dan, wherever it is.
Yeah, just email me. Yep.
And he'll be able to help you. So email's right there, dan@therateupdate.com. Cool. Let's see. What's a good amount to have as cash reserves? 3, 6, 12 months of monthly mortgage. So I think sometimes with reserves, it can get a little confusing, because sometimes, first of all, I guess I should say a reserve is basically, I guess I have to start from the beginning, because it can be, I was going to say one thing and I realized I can't do it. Okay. 2 different types. One is required reserves and one is optional. So sometimes when you're getting a mortgage, if you have a lower credit score, or you're buying like a multifamily home or an investment home, those can often have required reserve requirements. And so what that would mean is you're going to take whatever your mortgage payment would be. Let's say that the mortgage payment's going to be $2,000 per month. And let's say you're buying a multifamily home. Well, it might require, let's say, 3 months of reserves. So that would be $6,000 that's left over in your bank account after you pay for your down payment and closing costs. So it doesn't mean that that's a fee. They're not going to take that money from you. They just want to make sure that when you buy the home, you don't wipe your bank account down to zero. You have to have some money left over in your account. So that's required reserves. Most of the time, you're not going to see required reserves, again, unless you're buying a multifamily home or an investment home, or you have a low credit score. Most people don't have required reserves. However, there's optional reserves. I think it's smart to buy a home with at least 3 months of reserves. Now, optional reserves are calculated a little bit differently. So I think for optional reserves, think of it like an emergency fund. So I think everybody should strive for a goal of 3 months of emergency fund. That means take your living expenses. So some people do this at like their survival number. Some people do it with their current lifestyle. Let's say that right now, to pay for your gas and groceries, your phone bill, internet, all your utilities, your current rent, things like that. Let's say it comes out to $5,000 per month. Okay, so a 3-month emergency fund would then be $15,000. So the goal then would be able to buy a home, pay for the down payment and closing costs, and still have $15,000 left over. Because a lot of people they buy a house and they drain their bank account in the process, which kind of leaves you in a spot where if you need to pay for anything else in the meantime, you're putting it on credit. So you're paying for a credit card for maybe things like furniture or moving expenses, things like that. And that can put you in a tough situation pretty quickly. So I hope that explains it. I know there's two different types of reserves and they can be kind of confusing. But yeah, most of the time you're not going to run into required reserves, but optional reserves, I think you should have a 3-month emergency fund before you buy a house to make sure you don't feel super stressed during the process. Terrell Duckworth said, we plan to use a VA loan. I have an average credit score of 650, but my wife has an average of 560. Like flipped. How will this affect us getting a house? We make more than $145,000 annually.
I don't know how bad the credit piece is with the 560, but you should be okay because VA doesn't technically have a minimum credit score. Technically, so does FHA doesn't either, but they do publish saying, we do go under, 580 or whatever, but it's really hard to get approved at that. But in your case, VA, you're solid, income solid. As long as the credit's not real bad, you shouldn't have any problems. Please check. We're great at VA loans. So I'd love to work with you if it's possible.
Sweet. Okay. Dakota. Also, Dakota, you've been here quite a bit. Thanks for being here again. When I decide to sell my home, do I owe taxes on the remaining balance of the home? So I'm assuming you're talking about, maybe they're talking about like capital gains taxes. Is that kind of what you're thinking there?
Do I owe taxes on the remaining balance of the home loan? Yeah, maybe.
So you don't really owe taxes on the home loan, but if you do sell, there's going to be capital gains taxes, and there's a couple like exclusions there. So I have it pulled up over here. So if you've owned the home and lived in it as your primary residence for at least 2 out of the last 5 years, then you qualify for the capital gains exception. And the exclusion amount goes up to $250,000 in capital gains if you're single, $500,000 if you're married filing jointly. And that's in the profit that you make on the home. So if you sold your house and you've been living in it for the past few years, and let's say the profit that you made on that home is, you're going to get a check for $100,000 because of the appreciation on it, then you wouldn't owe any capital gains taxes. However, if you lived in the home, let's say the past 5 years, or even the past, 2 out of the past 5 years, let's say you made $300,000, then you're going to pay taxes on that money. But it's not going to be based on the loan. It's going to be based on the actual profit that you would make from selling that home if you did make a profit on it. Zeal said, do lenders make more money if they sell you points? I'm wondering if it was a good idea to buy a VA refinance loan of 5.5% to 5.25 for $3,000, but the lender gave me that as a default option.
No, how we don't make any more money. It's basically illegal for us to make any more than legally we're allowed to make. So, no, we don't make more money. Basically, it's you're buying down the rate. So it's like, if the rate's 5.5 and you want to buy it down, you can buy it down to 5.25. It's the same like today. I mean, 5.5 is an excellent rate. Let's say in today's rate on, an FHA loan is maybe 6.25. Well, you can get 5.99 if you pay points. So on our end, it's basically you're just buying the rate down and you're prepaying interest on that. So no, but the
Hmm.
banks don't make money. I mean, some banks might, we don't. It just, we say, here's your rate, and we call it par. We say, here's your rate, and par means it doesn't cost you anything. Or here's your rate, but there's discount points. So if you want to buy down your rate to a lower rate, you have the ability to do that. And it's kind of, just think of it as prepaid interest.
I like it. Michael said, okay, thank you guys. You're welcome, Michael. Thanks for asking. Stan Cal said, if you have a base salary, a variable bonus commission, and a constant bonus, do lenders treat your income as salary plus constant bonus plus average of variable income? Good question. So they actually look at all of them differently. So the, I mean, if you're interested, I can send you a spreadsheet that does all the calculations. But what ends up happening is they're going to take a look at base pay first. So that's because that's the most consistent. So they'll look at base pay on its own, calculate that out over 12 months, maybe 2 years. And it's really just going to depend how you get paid. And there's different calculations for, that lenders use to look at kind of the history of that income, how it's been trending. So if it's gone up, they're not just going to use the higher amount. They're going to average that over the time that you've been working. Or if it's going down, they're going to use the lower of that amount. They can't use an average because it's decreasing. So there's a lot of different rules in there. So it's kind of hard to say, just from one comment, the way that it's going to be treated. But then variable income, so things like bonuses, commission, tips, things like that, are then going to be averaged over a longer period of time and treated separately. So there's basically multiple calculations on the different types of income, fixed income versus variable, or you have your base salary. And then once those are all calculated separately, then they're going to be added together to make your qualifying income. So unfortunately, in the mortgage world, income calculations are one of the most complex things.
I do them
And
every day. And you did a good job at that. So it's like,
they're,
yeah, we've been, if you've been on the job a long time, what I would say is just take your last 3 years income and divide it out by 36 months and take it that's the simplest way. Cause I break it down per how many hours, you worked for the year. So a lot of times if you're seeking a pre-approval, I'll just get you prepped a little bit. Get your last pay stubs from the last 2 years. And the reason why I'm asking for those is it's going to break down your income and on all those categories. So it'll be easier for us to decipher, what's your wages, what's your commission, what's your bonuses. Your W-2s won't say that. And sometimes when we send in, for verification of employment on you, we'll get it back, but it might just say a lump sum or something like that. So if you have your pay stubs handy, it's really helpful for us to determine your income.
Joe AF said, great, thanks. One more question about an off-market home. So is it like a normal house on the market? I'll need an inspection before any loan type is approved.
Yes, do all your due diligence. And the tough thing, Joe, here I would strongly suggest you get an attorney, and here's why. We have 2 or 3 loans that are, I'm pointing out here, in the bin out here, and we've been messing with them for 2 months, some of these. And the problem is they were buying from family members or whatever, and there's liens on title that they didn't know
Oh, that's fun.
existed. You have to get a ton of things done in the background. So one was a title issues. They had tons of liens on the property that never were released. So it took us about a month to go back through all these and get the releases and everything. So it's daunting. So I would highly suggest you get an attorney so they can do all that, because the attorney, that's their piece of it anyways, to do the title work on the property. And that's the biggest cost you have. But if you're buying it directly from a person, you did well there because you're saving all those commissions. Spend a little bit of money and get an attorney. I would highly suggest it. I get one on every home that I buy, and I kid you not. It's just an insurance policy.
You hear the purring? Or is it too quiet?
Oh, I do. I hear it.
Let's see. Stan said, appreciate all your answers and expertise. Thank you. And yeah, just shoot me an email and I can send that spreadsheet over to you. Gamby said, never really comment, but just wanted to say I've been following for some time now, and others just appreciate the information you put up here. Lots of us grew up learning in school. Columbus discovered America.
Gamby, I'd love your picture. I'm from a small town in West Virginia that my dad, my uncles, everybody worked in the steel mills. What do you do? I love the picture of you. It looks like you're on I don't know, a cherry picker or something like that. And if you don't mind, what do you do? I'd love to know, because manufacturing in this country, you'd get what I'm saying. It's dismal right now, and it's, you look at a lot of the employment numbers, and I always look at the manufacturing numbers where they are, and you'll have 100,000 government workers added, 100,000 service people added, 1,000 manufacturing. That's not a good economy, folks.
They said iron worker in New York City.
Fantastic.
That makes sense from the picture.
I got a lot of friends that are iron workers. The guy's a stud. The guy's a stud. I'll tell you that right now. God bless you, man. Be safe out there.
Does he have harness on in that picture? That freaks me out.
I got 3 buddies that are iron workers, and man, they are just they're tough guys. It takes, you're getting way up on there. I have one buddy that built the Three River Stadium, whatever the stadium is there, the Bears Stadium, things like that. And what they do is amazing. So thank you so much, Gammy. If you ever need help with anything, contact me directly. I'm on your side, buddy.
Stephen Curtis said, "What is
we're supposed to do? Grants."
Yeah, we'll get there. So we'll get there soon. What's the best way to buy a house when you currently own? When you currently own one, take out a HELOC so that the offer is not contingent on the sale of your house. I feel like the HELOC is beneficial for a strong offer. And then also, I'm not worried about my house not selling, but with the HELOC, I can probably put down $300,000. Wow. I just don't want to wait for my new house to sell to lock in a contract for a new house. Very inconvenient.
I just actually approved 2 friends of mine, and one's on a plane right now down to Florida. They're buying a house down in Florida, and we just took out an equity loan on their house that they had free and clear. So they're basically, it's sitting in their bank account, just waiting to get that contract under offer. HELOCs sometimes can be a little bit more difficult because their LTVs won't go as high. It's a variable rate. Sometimes the rate is like prime plus something. So prime right now, I think, is at 8. So if you're prime plus 1, you're looking at a 9% rate. You might want to just get a standard mortgage on the property, and then once the house sells, just transfer the money over and pay it off. That's what I would do.
Cool. Let's jump into some grants here really quickly, since I was going to do it when we were at like 30 minutes, but I kind of forgot.
Hey, I'm glad he came on and said that. We've been wanting to do this for the last couple of weeks because we're not getting as much traction on this. And guys, it's as close to free money as you can get, and it's not a joke. So Kyle put this entire platform together. He's the man. He's down there. I'll take no credit for it. So Kyle, take it away, bud. Show him your masterpiece.
Oh, all right. Well, okay. So we have 3 different grants that are offered through our mortgage team at ServBank. So what you'll do is you can go to winthehouseyoulove.com. URL's right up there at the top, and just go to Grant Finder here. So basically, these grants all have different kind of qualifying criteria and stuff, credit scores and where you're buying and things like that. So we just made it easy. Instead of you having to look through all the details, you just answer a couple questions. It should take you like 5 minutes tops, and maybe not even that, 3 minutes to go through the questions here to see which ones you qualify for. And then we have a way that you can kind of explore how that's going to impact your payment. So first, you just answer, will another person be on the loan, or will you have a co-borrower? And Eric, thanks for the super chat. I will get to that here in just 1 second after I run through these questions. Okay, so let's just say through this example, let's say it's just me on the loan, or it's just you on the loan. So then you put in your credit score. The minimum for all of these is 620 since they're all conventional loans. So I'm going to say our credit score here is, let's say it's 750. We'll see if you're a first-time home buyer. If you have a question about what that means, you just hover over the question mark right here. And then you can put in, do you currently live in one of these areas? Okay. So, from this list, a lot of different places, did it get all of them on screen? Not all of them, but I can go through a list. We have, areas in Phoenix. There are areas in Miami, Fort Lauderdale, Atlanta, Chicago, Baltimore, Detroit, St. Louis, Newark, Jersey City, New York City, Cleveland, Oklahoma City, Philadelphia, Memphis. Tons of cities in here qualify. There's over 11,000 areas that qualify. So I'm going to say yes. Then here's the part that gets a little bit weird. You have to do a couple extra steps. So 2 of these grants are based on where you currently live with what's called a FIPS number. So it's basically smaller than a zip code, but you have to be able to enter in that number. So what you do is I have a little quick tutorial that you can watch, which is going to cover exactly what I'm doing in this video. So what you'll do is you'll open up the Fannie Mae lookup tool. Now my browser has been acting weird, so I'm going to open up a Safari browser really quickly to pull this open. Okay, I just want to make sure
when you first go there, many times you're like, when I did it, I didn't see the screen that you showed on the video, but there was like, you just have to hit like an OK button to get through it.
Yes.
You know what I mean?
I just want to make sure it didn't auto-populate my address in here. This is what that screen looks like. And what you're going to do is you're going to enter in your home address. So not where you want to buy, exactly where you currently live. So it's your primary address. It's a little bit different than some other grants. Some grants are about where you're buying. 2 of these grants are actually where you currently live. It's weird. I don't know why they're set up that way, but that's how it works. So what you do is, let's say you were looking in this area. That number right here is, see, it says FIPS, F-I-P-S. What you're going to do is enter this number into the grant finder. Okay, so I would enter that number over here. Now, just for ease of use, I'm going to type in a short code for one. I know that works. That way we don't have to pull up someone's address on a live stream and dox somebody. Then underneath special focus areas, you're going to look and see, does it say home ready first? It either will say it or it won't say it. So we're going to say that it does say it here. Then you'll put in what your annual pre-tax income is. So let's say we'll put in $90,000 per year. And then where you're looking to buy. Okay, so put in the state, the county, and then you can even see all of the different county limits here, which I can show you here in just a little bit. You'll put in the purchase price. So let's say we're looking at something, I don't know, $350,000. We're going to stick with the normal down payment minimum. And then it's going to show you grants that match the profile. So all of these grants here, they're fully forgivable at closing. There's 0 repayment on the grant, and then you can sell or refinance at any time. So a lot of down payment assistance programs, they usually are going to have some sort of monthly payment, some sort of interest rate. And then also if you sell or refinance, maybe within 5 years, they might request all of that money back or some of that money back. And unfortunately, with a lot of people in down payment assistance programs is, I know this happened quite a bit when we saw that huge interest rate drop a couple of years ago, is people were in these loans. Let's say they were at that time, probably a 6% rate. Rates dropped down to 3%. But because they used down payment assistance in the beginning, they couldn't refinance down to those lower amounts without paying a few $1,000s. Now, in my opinion, that made sense to drop to that lower rate, but some people couldn't do that. They couldn't spot the few $1,000s to pay back the down payment assistance. What's nice about grants is they're forgivable at closing. So just for an extreme example, you could buy a home, use the grant, sell it the next day if you wanted to, and no one's going to ask for that money back. So from here, it shows you the different grants we have, how much you can qualify up to, and then you can apply for them directly right here with our team at ServBank. Okay. Now, something that you'll see here is this one says the income is too high to use this. So what you could actually do is scroll back up here. So we said our income is $90,000. We can actually take a look at all of the counties. So for instance, let's say you made $80,000 for just a better example. Well, everything down here, you wouldn't be able to qualify in these counties. However, if you were able to actually look at different counties for where you want to buy a house, you could qualify in all of these because the income limit is higher. So that's something, a little trick you can use if you're running into an issue there. So then what we can do is look at a cost estimate comparison. So in here, we're just estimating things like closing costs. So these are going to be things like property taxes, homeowners insurance, title insurance, possible recording fees, transfer taxes, things like that. So we're using a really rough estimate for closing costs. But what it will show you is the down payment, an estimate of the closing costs, And then also, if you had the seller pay a percentage of the purchase price towards your closing cost. So, for instance, let's say that we could get the seller to pay 1.5%, and that's something you would negotiate with your real estate agent. You could see that before the grant, this is what the cost of buying might be for you. Okay. So it'd be around $13,000. Now, with these different grants, you can see what that would take that down to. So it shows you the grant plus some of these grants offer an appraisal credit, and some of them, one of them offers a home warranty credit as well that can help reduce the total cost out of pocket for you as well. So this is a really easy way without having to jump on the phone or do an application to see if you can match with one of these grants. And then you would just click apply to reach out to us to confirm that you qualify for these grants. So they go all the way up to $7,368. These two grants are a static amount. Purchase Plus is always going to be $5,250. Home Ready First is always going to be $6,500. One Plus is a little bit different in that it's a 2% grant. So you pay 1% down payment and there's a 2% grant. So that changes based on the purchase price that you're looking at. So anything else you want to cover in these grants, Dan?
No, no, that's perfect. The other one was mainly if we could go over since we are a bank, a federal bank, we also got money from the Federal Home Loan Bank of Chicago to offer it for the Chicagoland area. So that says the Illinois grant. It's almost virtually the same thing. That Kyle created this website as well, and it's going to give you the counties that you qualify for, but not every house is going to qualify. It's going to be, you have to basically do the geo code again, but this one's a little bit easier. I find this one a little bit easier. The Illinois grant, remember when you were creating this, it's like you can't copy and paste that FI, the number over there. So you have to kind of put it on another screen and translate it over there. On this one, it's actually a different code that you use, and you can just copy and paste it right into the thing, and it'll tell you right there and then, do you qualify for that? And it's the Illinois grant. The benefit there is it is $10,000, and it qualifies you. Most of these programs are only available if you're a home ready or home possible. The Illinois grant that we have, you just have to be in the specific coding section and can't make over X amount, and you qualify on that. You want to run through that? I don't know if we have it. Do we have anybody on here from Illinois? Give us a thumbs up if you're anywhere in the Chicagoland area in Illinois. Just thumbs up.
Let's see. We did have a question here about the FIPS number. So it's where you're currently at, where you currently live. So I try to make that in the videos I keep reiterating that just because people still keep putting in where they want to buy. Currently live, where you currently live. Even in here, I put in current address. And in the tutorial, I say it as well. So just to make sure, don't put in where you're wanting to buy, because that's not how the grant works. So we have people who keep putting in where they want to buy. Don't do that. Okay, let's get to
somebody in Logan Square. That's down near where Patrick moved to.
Thanks for the super chat, Eric. You said, first time tuning in, I'm just soaking in all the information. My fiance even use did you know fiance can be spelled different ways depending on who you're talking about?
You're talking to me. I have a tough time spelling my name.
But I kind of forget which one is which. Let's see. My fiance and I are looking to buy. Both of us are in the fire services for a long time. Credit in the high 600s. Hers is in the 700s. Can I call and set up a chat? Oh, absolutely. So probably the best way. Eric said it is the autocorrect.
Eric, email me. Just email me, Eric. I'll call you after the live event.
Yeah, Dan@therateupdate.com. I'm hidden, but that's going to be the best way to reach out.
And just shoot me an email. Give me your phone number, and as soon as this live event is over, I got to do just a couple things, and then I'll give you a jingle.
A jingle. Okay, sweet. So, just one other quick thing with the grants. I know a lot, kind of the big question is why is this money even being offered? What's the catch? Why is it not a higher interest rate and stuff like that? So this is federal money that's available So we work with different wholesale lenders. So they all have their own different versions of the program. So that's why we have 4 of them. 3 of them work wherever you're buying nationally. One of them, like we mentioned, is the Illinois grant. So it's only in the Chicago-ish area. So this is all federal money that's available to these different wholesale lenders. And it's basically like a use it or lose it type thing. So that's why they offer these, is that they're not giving this because they're getting some benefit on the back end. The benefit that they get is they get business from it. They get to close an extra mortgage because they have this federal money available to them. And so that's why whenever we do consult calls, if you schedule a call with us at whenthehouseyoulove.com, is we run this on every single call, because if we can get you access to this federal money that's available, it's really just best to take it, because there really is no con, and that money is just sitting there waiting to be used, and we want to be able to let you use that. So I'll put Dan's rateupdate.com. I'll put Dan's email here in the chat. Logan said, first I want to say thank you for your videos. They've been very great for my fiance to go through documents. Awesome.
You know, there's different ways to spell fiance.
I can barely spell my own name. So is that what you said?
I'm just being an ass. Sorry. Well,
I was wondering. I was like, mate,
it's funny you have a back-to-back one that had fiance in there.
I know. I was thinking maybe you should have bring it up again. I was like, no, it's not that serious. We closed on our house on the 18th. We were pre-approved at a certain rate by, as of this morning. I'm assuming they're pre-approved for a certain rate by the 18th, maybe. As of this morning, our rate changed since last week. He said something about bond markets, but is he lying? So what I'm imagining is happening is that your rate right now is floating. So let me go to the little chart here. So this is what's happened with rates in the past. Let's see. We had this. Oh, let me take the comment off so you can see it.
Yeah.
So you can see rates have taken this massive increase here. So your rate changing is nobody lying. Rates have increased for everybody.
Look at that jump. When's the jump? When's that initial scroll right there? What day is it?
October 3rd.
What's today? The 3rd, 20-something.
Wow. 23rd.
It's 2-3 weeks. It went from about 6.25 to almost 7. That's a big move. That's a big move.
Yeah. So with your interest rate, basically most people are getting a 30-year fixed loan. That's what most people are going to be getting when they're looking at buying a house. So what that means is once you close on a home, your interest rate is fixed for the next 30 years, meaning it's not going to change for the next 30 years. So if you close on the home at 6.5%, you're going to have 6.5% 10 years from now, 15 years from now, 30 years from now. It's going to be that same rate. However, before you close, in between getting pre-qualified, being under contract, and closing, so until you close, your rate can be one of 2 things. It's either going to be floating or it's going to be locked. So floating is basically floating with the market. So you can kind of think of it like, imagine my mouse is a little boat, and this little blue is water here, and it's floating on top of this wave. You like that?
I like that.
So what's happening is it's floating along here with this wave. So if it goes down, right, our interest rate goes down. If it goes up, it starts going up. Our interest rate floats with what's happening in the market. So if you got pre-qualified here and your loan officer's like, you'll get a 6, right now you're pre-qualified at a 6.12% rate or 6% rate, then you're like, cool, that's awesome. Let's say you get under contract and rates are here right now. Well, if your rate is still floating, if you didn't lock it in, well, okay, if you're not closing till, let's say, maybe today, well, your rate still was floating with the market. Now it's a 6.8%. So no one was lying to you. It's just that your rate is floating. The opposite of that is locking it. So locking rates happens at different intervals. So normally, most lenders are looking at 30 to 45-day locks. So that means if we get you pre-qualified, and you get a home under contract, what we can do is lock that rate in for 30 days, meaning that if you close within 30 days, that you'll have that rate. It's yours for the rest of your loan, 30 years or whatever. If you choose to float it, then it's going to float with the market until it gets locked. Okay. So rate lock decisions, that's why Dan monitors rates all day long. And I'm sure has had some sleepless nights over rates, because this
Oh,
is what
man.
we monitor and take a look at, trying to see when's the best time to float or lock rates. My opinion is always of, we can try to take a guess on what's going to happen with the market, but when it comes to rates, if you like it, lock it. Uh, I You can always take a gamble on floating for things to go down. A lot of people tried to do that with the Fed decision. They were like, the Fed's going to cut rates. And we keep telling people the Fed doesn't control mortgage rates. Once they cut rates, it's not going to change things. And that's exactly what we saw happen here, right? The Fed decision was, it was mid September, right? What happened? Did rates go down? No, they actually have gone up since then. And so really, we don't suggest gambling on floating unless you're comfortable with them going up. As much as they can go up, or as much as they can go down, they can also go up. So when we're talking about rate locks, this is our suggestion here. If you're closing within 7 days, you got to lock it. If you're closing within 15 days, we suggest locking it right now, because we don't know in the near future what rates are going to do. If you're looking at 30 days, 45 days, 90 days until you're closing, then floating is probably best to see what's going to happen with the market. There may be some corrections that you can take advantage of. So I know it's a long explanation here, but
That's
anything you
good. I
want
mean, it's a
to
lot of
add on
people
to it?
just don't. Yeah, they just don't understand the difference between low. That's why we do offer a service as well, where we'll compare your offer with what we can get you. But a lot of people, they're still floating on the rate, so I can't really give you a competitive bid on what they're at, what they're providing, because their bid might be from 2 weeks ago. And if let's
Yeah,
just say if you had a loan estimate from 2 3 weeks ago, that rate's 6. You send it to me now, and you didn't lock it. And then you come to me and say, hey, can you beat this? I'm like, well, my rate today is 7. And so here's what I tell people to do. Go back to your other lender and get their best quote, because they have all your data, and then let me know what they're doing for you. And then I can let you know, give you a thumbs up or a thumbs down on it. But if
yeah,
you haven't locked in the last week or so, man, the rates are jumping big.
yeah. Yeah, and that's a really good point, because I know a lot of times people, they think that rates are just like fixed. Here's what this one lender is offering me, and it's actually what the lender's offering based on the market, because the
Yeah.
markets change multiple times a day. And so, yeah, to Dan's, to your point, I mean, hopefully someone's not giving us a quote from a week ago, but even when rates are here, if you got a quote 10 days ago or somewhere around there, and then you try to take a look at a quote now with a different lender, well, lender B is going to show you a higher rate. And so you might say, well, I'm going to go with lender A. Well, lender A still has probably the same higher rate that lender B does.
Yeah.
It's just that over time that market changed. And so they're not going to let you close on that lower rate because it was floating. So rates aren't guaranteed until they're locked. And even then they have to be closed within that certain time period. So I know it can get really tricky and a little bit weird. That's why, you want to rely on your loan officer and kind of talk to them about, hey, if you're not comfortable with things changing, go ahead and lock it in. And you can lock that in for as long as your contract date is to make sure that you have that.
Yeah.
Logan said, I don't know how the sales of lenders are, so part of me thinks he's trying to get more of a higher rate so he gets more of a commission. So just if it helps out at any to kind of ease your concerns there, no lender in the U.S. is allowed to make more money on a higher rate than a lower rate. So it's just illegal. It's like super illegal.
Yeah.
um, that
Our
would be
comp
kind of,
plans, how we get paid, it is really strict. So we can't make any differentials on your higher rates, lower rates, or anything. We get a commission on the loan amount, and the rate is just what the best rate we can find you. We don't really make
yeah.
any money on the rate.
Well, I know a couple of weeks ago, someone mentioned like, what was it? Something along the lines of like, lenders are making 8% and they're like so greedy they should drop the rates and they're making so much money. And I kind of mentioned like, well, when rates were 3%, lenders,
How am
us
I making
included, we
8%?
we made the same. Lenders make the
Yeah.
same amount of money no matter what the interest rate is. So we made the same amount of money on a 3% loan as an 8% loan. The reason why the rates change is not because the lenders are greedy and they're not pocketing the extra money. It's all happening on the secondary market. So as much as the interest rate goes up, meaning that means the people who buy the bonds when they're securitized on the secondary market, they're requiring higher payments. So the interest rate is higher, all that profit doesn't go to the lender. That profit has to then be passed on the secondary market, higher payouts, because there's higher risk involved in the market. So Um, yeah, rates don't quite work, I think, in the way that a lot of people think they do, because most of the U.S. mortgage market is all based on secondary market movement. Said, is there anything I qualify for if I'm buying a house for the third time?
So I'll start it this way. Is this going to be the third house? Like I'm in my third or fourth house. Do you own all those properties, or you're just like upsizing or downsizing or whatever? Because almost every program is available to you. You just might, like FHA, you can do another FHA loan if you want. If it's a VA loan, you can do a VA loan if you want. If it's a conventional loan, you can do that. So I don't think the only thing that's usually different is a lot of first-time homebuyers can get away with 3% of a down payment, where if you're not a first-time homebuyer, and there's specifications on what the definition is, then you need to put down 5% instead of 3. That's virtually almost the only difference with that. And then you wouldn't qualify for home ready, because then you've had a house or in the last 3 years, so you wouldn't qualify for that, but you'd still qualify for conventional FHA and VA. So unless, if you can clarify it, is it going to be a third home like a rental, or you're just moving to the third different place? And love to answer that if you're still with us.
Yeah, that does get a little tricky sometimes. Sweet. So let me jump over here. So if you have any more questions, or you want to get pre-qualified, you want to schedule a call with us, there's tons of ways that you can reach out to us. One, our emails are here. So you can also go to Dan's channel, the rate update, my channel, Win the House You Love. Here's both of our there it is, both of our emails as well. If you want to reach out to us, another way as well is you can go to our website here, winthehouseyoulove.com. Is mine. Dan's is the rateupdate.com. And you can just click get pre-qualified to schedule a call with a member of our team. If you have a question too, you can also click I have a question first, and ask us a question and get a reply as well. So it really just depends how you want to reach out to us. And again, those grants here, if you go to tools under the grant finder, can also be a really good way to see if you qualify for any of those grants before. And even if you don't, the minimum down payment on a conventional loan is 3%. The minimum down on an FHA loan is 3.5%. So the down payments aren't crazy high. I think a lot of people still think down payments are like 20%. They need tens of thousands of dollars to buy a house. And in most situations, you just don't need that much. So we'd love to be able to help you. We're going to do this live stream again next week, same time, same place, on my channel, on Dan's channel as well, 3:30 Eastern, on Wednesday. So we'd love to see you all there. And thanks for joining us.
Thanks for joining us. We'll see you next week. Have a good one.